Now, ahead of the all-important Federal Reserve decision on US interest rates, and on a day when the stock market went up despite a near 100% expectation of a rate rise in the USA, let's just see how a master fund manager like Anton Tagliaferro of Investors Mutual is playing stocks right now. Anton, great to see you.
Good evening, Pete.
Now, I purposefully linked you to the Fed decision because, you know, you've made the comment to me on many occasions that things get a bit tough in this low interest rate environment. What do you mean by that?
What I mean is obviously stock markets have been re-rated, you know. If you look at the Dow Jones, obviously at a record high. Australia's not far off a 12-month high. You know, some sectors like the banks are at pretty high levels. So low interest rates is obviously forcing people to look for yield, to look for alternatives to cash, which means asset prices are being pushed higher. And we see that in the property market as well, in Sydney, obviously, and in many places around the world. So, yeah, as I said, the low interest rates is affecting asset prices. So the problem is, you know, when there is a change of interest rates one day, you know, if they go up quite a bit, then what happens to asset prices?
Now, when I was a young man, I heard you do a presentation to a large group of investors. You would have been a young man as well at the time too.
It must have been a long time ago, Pete.
It was a long time ago. But one of the points you made was that you don't like to invest in businesses where you just don't understand what was going on. And I won't name the company in question because at that point in time, people didn't know what was going on. But now, this low interest rate environment, you've never invested in an environment like this, have you? You've never invested in this kind of... And even now, we don't know when interest rates will rise in Australia. Has that made investing a lot more difficult because the usual parameters of rising interest rates and inflation haven't been there?
Yeah, well, normally, as you're saying, the last 20 or 30 years, we've seen this economic cycle, you know, of high GDP growth, inflation picks up, interest rates go up, slows everything down, etc., etc. But obviously, since the GFC, which is now 10 years ago, we haven't had that. You know, we obviously had a huge downturn in most parts of the world. Australia managed to avoid a recession thanks to the $800-900 handouts, etc. But the rest of the world had a serious downturn, and we've seen since then, you know, these very low interest rates, these very accommodative policies from the central banks who are trying to keep the world sort of at this, you know, in the positive, so to speak. So, yeah, it is difficult because, you know, there will be a downturn at some point, you know, in terms of cycles, but... And interest rates are artificially low. I mean, if you look at Australia, where we have unemployment, which is, you know, around the 5-6%, house prices are strong, commodity prices have picked up, and yet, you know, interest rates are still at 50-year lows or whatever they are. So you say to yourself, do Australian interest rates really have to be that low? Similarly, in the US, where their unemployment is now below 5%, where the stock market's healthy, the property market's recovered. I mean, why are rates so low, you know? So, you know, the rates will have to go up at some point. Obviously, central banks are still cautious on the economic recovery. But yes, it's difficult because asset prices are being pushed up because of these low asset prices,
now today,
because of these low interest rates.
Today, my colleague Paul Rickard and myself had a bit of a debate about whether Telstra is a buy or a sell at these levels. Now, Telstra clearly is a dividend play and interest rates are really low, and dividends have become a really popular, more than ever, a popular play for lots of investors, not just retirees, but lots of investors. And I'll get you to talk about Telstra specifically, you know, in a moment. But as I said to Paul at the time, well, and he made the point that the current dividend yield's around 6%. I said, well, franking credits, it climbs up to over 8%. Even at 6% without franking credits, with franking credits, it's still a good play in this low interest rate environment. So dividends are going to be a reliable play for at least the next 2 or 3 years?
Look, obviously dividends, I think, will always have a part in people's portfolio, whether rates are 2% or 4%, you know, a dividend yield of 5 or 6% is still a good return.
Yeah.
And a nice safety net. I guess the issue with Telstra is not so much the dividend is a very good dividend at 31 cents. I think, you know, at $4.50 it was almost 6.8.
Yeah.
We were buying a few at the 450s. The issue for Telstra, the dividend, the 31-cent dividend is secure for the next couple of years, 2 to 3 years.
Yeah.
The issue with Telstra is in 2 to 3 years, you know, when the NBN is rolled out, Telstra will lose all the fixed line revenues.
Yes.
So Telstra is saying they're going to have, they are going to have a $2 to $3 billion EBITDA gap.
Black
in
hole.
their, well, they've got this gap to fill between today and 2020, 21. Telstra has got to find 2 or 3 billion if they are to maintain this dividend of 31 cents. So yes, it is on a good yield. The question is it sustainable? You know, in terms of Telstra has plans on how to breach the 2 to 3 billion. They themselves are not sure if they can fully fill the gap, by the way, but they're doing things. For example, they've said that they're trying to find $1 billion in cost savings. They're hoping that they'll get some growth out of mobile. They're hoping that some of their divisions, like the NAS division, will continue to grow, etc., etc. So they have a plan between now and 2020 to take out between 2 or 3 billion, to add 2 or 3 billion to the EBITDA. So if Telstra is successful, they will be able to maintain that dividend. But that's, you know, that's about as good as it gets. But there is risk to that dividend, I suppose. That's the only issue.
But I think the point I made to Paul was, well, even if they did cut the dividend, it still would be a pretty good yield compared to a lot of other companies, and definitely compared to international companies.
Yes, Peter. The only thing you have to understand is every $1 billion of EBITDA that Telstra doesn't fill is about 6 to 10 cents a share in dividends. So if Telstra managed to find 2 billion out of that 3 that they're going to lose, then they have to cut that dividend by 10 cents. So this is the doubt. As I said, this year, next year, the dividend's secure. But as you go into 19, 20, you know, it really then is a matter of you know, will investors feel confident that the company's done enough, and the company itself will know actually in 2 years' time whether it'll be able to fill that $2 to $3 billion gap.
Would a cut, and even a better than projected cut in company tax, be good for our stock market?
Naturally, of course. I mean, everybody.
Tell us why.
Well, obviously it adds to net profit after tax, it adds to earnings per share, and you know, obviously, you know, it becomes a source of earnings growth.
Yeah, Anton, and I'm totally on board with you, but I have had some viewer emails saying, but hang on, if they cut the company tax, doesn't the franking credits go down as well?
That's true, but then on the other hand, the overall profitability of the company goes up, and you know, the value of the company should go up because the profits are up.
But you can understand that the investor out there
franking,
who plays
just franking,
franking.
Well, there is
that was unnerved them, isn't it?
Yeah,
I know. Okay.
But overall, it would be a positive if company tax rates were cut.
There's another question I often get: could the government, in searching for, you know, solutions to the budget deficit, ever change the franking credits arrangement, which, you know, clearly the Americans don't have? Does that worry you, or would that be too big a step politically?
I think politically, you know, I think unfortunately we've had a number of governments in recent years who don't seem to have really, you know, the backbone or the strength, and to be honest, the support from the Senate to be able to pass controversial laws, be it for franking credits, be it for negative gearing, be it for Medicare changes, you know. So I think the government's pretty limited at the moment in terms of what it can do.
That's the big, high-level thinking issues. Let's get down and dirty now, Anton. How are you investing for 2017?
Yeah, look, Peter, we still think the environment is still quite tough. I mean, I know the market's up and everyone's a bit excitable at the moment, but, you know, we had many companies come through and see us in February, you know, through the reporting season. Yeah. And, you know, most companies, I'd say easily more than 90% of companies, you know, saying things are quite tough.
So was it well coloured by the fact that mining companies, the big ones, have improved a lot faster than what most people expect, and that improved the whole earnings story in total?
Yes, of course, because BHP is obviously BHP and Rio have obviously gone up, helped by the iron ore price. But if you take that out of the equation, you know, if you talk about normal industrial companies, I mean, everyone's saying it's okay. The environment's okay, but there's no free kicks. You know, you got to work quite hard to get earnings growth. Similarly with the banks, I mean, CBA reported in February, and we had, you know, CBA come to see us, and, you know, while the result was, you know, pretty good and the market reacted positively, I think, as I said last time I was here, you know, a 2% increase in profits, I think even the company itself will admit it's okay, you know, in an environment where housing is booming, where bad debts are at a minimum, you know, a 2% increase in profits isn't, you know, you'd think you could do a bit better than that, I would have thought.
Now, you know, that for me to get tips out of you is like a dentist pulling a wisdom tooth out, and I emphasise the word wisdom, but nearly every time I've had you on here for 2 years since you and I went to lunch, I've brought up Woolworths, because you weren't a naysayer on Woolworths, but you wouldn't also over-promote its potential, but you certainly thought it would make a comeback at some point in time. Are you surprised how much it has rebounded?
A little bit, and similarly with Wesfarmers, which has bounced quite strongly. I mean, the reality is the supermarket sector is quite tough. Again, if you look at the half-year results, the Coles profit within Wesfarmers was down almost 10%, and they said it will get worse in the second half. Woolworths' EBIT, earnings before interest and tax, was down 14%. And the company is saying as well that be careful, don't compare the sales growth for this December 16 quarter to the previous December, because the previous December was that mess, remember, when they stuffed up completely Christmas. So even you know, I think the market's reaction's been a little bit over the top. The companies themselves are, you know, trying to hose down a little bit expectations in terms of, you know, Aldi's not going to go away. Woolworths and Coles are still battling themselves for market share. Aldi's moving further and further out west, you know, opening more stores in South Australia and West Australia. Also now coming back and opening stores on the East Coast. For example, they're opening a couple not far from where I live, you know, they're infilling areas. So
yeah, but you're too rich to go to Aldi. You know, you'd be a Woolworths.
You'll be surprised. Everybody goes to Aldi.
Now, have you and your pointy-headed experts in your illustrious organisation thought about Amazon and its potential impact on retailers?
Yes, Peter, again, I think that's overstated at the moment. I mean, Amazon haven't even got an operation here. You know, we've talked to people in the market. They're still looking for sites. So they're still looking to establish sites, and then, you know, they've got to find the sites. They've got to open them. They've got to... So we're talking quite a few years away before Amazon are up and operating in Australia. And also, you know, again, you know, operating in the US, where you have some dense cities like Los Angeles and New York, you know, Australia is quite a different place in terms of the vastness of it. But the most, I guess, as I said, Amazon are still a few years away. They've still got to establish their sites, and they've still got to build their warehouses, etc., etc. So they're looking, they're coming, but it's not going to happen, you know. We'll probably still be talking about it Christmas this year.
Okay. I'm not going to let you go unless you give me one company that you really like as a consequence of reporting season. Have you got one?
Look, there's a few we like. They're pretty boring companies, but the market...
We don't care, as long as they're good, mate.
Look, I think Amcor is fine. I mean, again, they had a reasonable result. Amcor is a huge packaging company, you know, around 60 countries around the world. The interim result was okay. They said the final result will be above last year, and they're saying next year's result will be higher as well because of acquisition. So I think Amcor's reasonably good. Spark Infrastructure we still like, you know, on a yield of 7%, I think 6 or 7%. Regulated utility. The result was fine. They've given distribution guidance. Not exciting, but it looks fine, you know. Those sort of stocks.
Are these the sort of funds that are also in your dividend fund?
Yeah, these are the sort of stocks. Well, as I said, you know, at the moment, I think, you know, we haven't changed in terms of the way we're looking at the world. It's still a low growth environment. As I said, most companies we've met are still saying it's reasonably tough. So I think when you can find companies that are growing, albeit slowly, paying a reasonable yield, you know, Anchor's on a 4% plus, Spark's on a 7% plus, and growing, they look pretty good, you know, compared to things like the banks, which have been re-rated, and the resource stocks, which have been, again, gone up very strongly on strong commodity prices.
As always, Anton, it's great to talk to you.
Good to be here, Pete. Thanks.
Anton Tagliaferro, the founder and brainwave behind Investors Mutual. After the break, we'll get some insight into the current state of the Australian property market with the Aussie Home Loans CEO, James Simond.